In this video, we will talk about what 90% of investors get wrong about valuation. Specific traps that will cost you thousands and thousands and thousands of capital in your portfolio. And if you don't understand valuation correctly, you may fall into terrible traps. So not understanding valuation is a big mistake in investing, but luckily for you, it's fixable. It's flexible, and in this video I will give you some tips so that you avoid falling into these traps. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year based on the principles of Warren Buffett. So I try to avoid as many mistakes as possible, and so far so good because the performance has been good. I plan to continue to do this in the future. So let's talk about valuation. We'll talk about a lot of examples, so you will have practical tips on this video. And I have a few points I want to share with you. So the first point I want to talk about is people that focus on PE ratios without understanding the business behind the number. So behind the numbers, you have several industries in this world. You have the software industry, retail industry, Walmart, Amazon, railroads, different industries with different margins. Okay, what will be the multiple for each industry? Luckily for you, this is not the same PE ratio if you are talking about a railroad or a social media. Similarly, you don't have the same PE ratios when it comes to countries. If you look at the PE ratio for the US, on average for the S&P 500, it's at 30 right now. But if you look at the PE ratio for China, it's half, between 10 and 15. If you look at the PE ratio for Japan, it should be around 14. Depending on the country of the company, depending on the industry of the company, the PE ratio will fluctuate because of the quality of the industry. If you are talking about a cyclical industry like the oil and gas or chemical equipment companies, for example, well, it's cyclical. Earnings are temporary. The business will make money for 2 years and then lose money for 2 years and then make money for 2 years and lose money. What is a good multiple for this? Because of the cyclicality, because of the volatility, the business doesn't deserve a premium. The business deserves a discount. So the PE ratio will be low. So it's a mistake to think all the low PE ratios mean the business is cheap. It's a mistake because it depends on the quality of the business. For example, you have two businesses. One, I would say, low quality, LQ, and one that is high quality. Two businesses have a PE ratio of 5. Okay? PE ratio, that's a PE of 5. Oh, 5. All right. For the low quality business, as I told you, when it comes to the free cash flow, the earnings, it will be very cyclical. So it will look like this. You can take a look at all the majors. You can look at all the cyclical companies, the companies about diet, for example, fitness equipment. It looks like this. And for your high quality business, the earnings, the revenue, the free cash flow will look like this. Two business models, okay, with different growth rates. So if you have a PE ratio of 5, it doesn't mean anything. So this business is smooth. This business deserves a premium. This business is a mess. They don't deserve a premium. They deserve a discount. Now, something else. I want to talk about something else. I want to talk about margins. Well, we've talked about the low quality of earnings for low quality business. Margins will look like this, negative, either low or negative. If this is our zero line, I would say a low quality business will either lose money or be at break even. Look at all the cyclical companies. And now, if this is my zero line, I would say high quality companies will start from higher margins, and the margins will improve a little bit every year. So a low PE ratio doesn't mean that is cheap. Only if you look at the PE ratio. Depending on the quality of the business, depending on the growth rate, depending on the margin profile, a PE ratio of 5 can be reasonable, or a P ratio of 5 could be a steal. If you had MasterCard trading at a P ratio of 5, please sell your house and buy the stock. This is not financial advice, but this is very unlikely to happen anyway. So you have a high quality business like MasterCard, Visa, MSCI at a low valuation. This is a golden opportunity. But for railroads, oil companies, this kind of difficult businesses to be in, transportation, I would say car makers. Car makers are a great example. Stellantis, Ford, this kind of stuff are struggling to make money, struggling against the Chinese competition, struggling to sustain their margins. Capital allocation decisions are horrible. They need to reinvest all the profits they have to invest in the new generation of EV cars, that is costing them a lot of capex, a lot of capital. They don't have any dry powder. They are filled with debt. Welcome to cyclical companies. Welcome to the game of investing in cyclical companies. Car makers are deserving a low valuation because we are talking about a low quality business. Okay, what we focus on this channel are companies that are high quality businesses that will be able to make you sleep well at night. You can sleep better at night because you own the best businesses of the world that will continue to improve because they've been improving for 20 years in a row. Look at this growth rate, wonderful, margin profile, wonderful, always profitable, stress-free investment. Okay, you buy at a reasonable price and that's it. What we focus on, and this is exactly the reason why I have outperformed the market for the past decade, is I have always favored high-quality businesses. Over the very long term, this is, I think, how you can outperform for the retail investor. You don't need to be smart. You don't need to be a genius. But I wanted to make this point very clear. A low PE ratio doesn't mean anything. And I see plenty of people making this mistake of saying, oh, it's a low PE ratio, so it's cheap, so I can buy it. No. First one, maybe the PE ratio that is low is deserved. And second point, a low PE, let me erase everything. Okay. A low PE ratio, let's say you have a business, low quality business with a PE ratio of 5. Okay, how do you calculate the PE ratio of 5? You have the market capitalization of the business divided by the total earnings of the business. Fair enough. What if the earnings of the business go down by 50%? You have a PE ratio that will go from 5 to 10. That means that a low PE ratio can be unsustainable if the quality of the business is bad. Because if earnings drop, the PE ratio will go up substantially. I have seen this example countless times for car makers, automakers in the US or in Europe. They have a low PE ratio, a high dividend yield. People think it's the cheapest investment of all time. Guess what? They are hit by a big recession, a big problem in the industry. Earnings completely collapse, and the PE ratio is not 5, but it's 15. So the business is not cheap anymore. So investing in low quality businesses can get you a lot of troubles. You will have a lot of headaches if you do this. This is why relying on a cheap PE ratio just for the sake of the low number is a huge mistake. And a lot of people, more than 90% of investors are doing this, are just talking about PE ratio without talking about the quality of the business. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Next point. They ignore the free cash flow and overvalue accounting profits. Yes, there is a distinction between earnings and free cash flow. Warren Buffett says you always want to favor free cash flow compared to earnings. For earnings, you can manipulate earnings quite easily actually. You play around with the costs, you play around with a little bit of everything, you have one-off investment gain, you can play around with your taxes, you can play around with many things. At the end of the day, what matters for stocks in the long term, this is the free cash flow. especially the free cash flow per share. Over the very long term, stock prices follow the free cash flow per share. This is even more true than the earnings per share. If you have the choice, always favor the free cash flow. So it doesn't mean that the free cash flow can't be manipulated, but it's way easier to manipulate your earnings. I have a master's degree in accounting, so we've learned a lot about accounting manipulation, how companies can trick us investors into thinking they are good businesses, but this is just a basic trap. And I spent countless hours on analyzing these kind of companies, these kind of traps, to not fall into them, okay? So if you want to avoid these kind of traps, please always compare the earnings and the free cash flow of the business. If these are the same or roughly the same with the same growth rate, you're good to go. But if you have a big difference between earnings and free cash flow, this is a big red flag. This is a big red flag, and you have to dig deeper. You have to be a detective and ask questions. And not a lot of people know how to understand the accounting behind these numbers. I have helped many people in the coaching program. We have calls every week, and we talk about these things, these potential red flags, because they come to the coaching program and they don't know how companies can fool them. How companies can manipulate numbers. Well, these are the kind of things that we talk about on the coaching program, so you can only invest in quality companies that are not cheating you, the shareholders. Okay, third point, they don't adjust for industry differences. Software is not retail. Yeah, this is what I told you about cyclicality, margin profile, growth rates. It depends. And I would say industry differences, but also country differences. A company in Japan will not have the same PE ratio as the same company in the US or the same company in Spain or Italy. They dismiss companies that became profitable only recently. Yeah, this is a tricky business, and I see a lot of people falling into this trap. They forget valuation is a mix of price, quality, and future expectations, not past earnings. Okay, this is why investing inside your circle of competence is key. Because if you are talking about a specific company, for example, imagine you want to buy a company. You say it has a cheap PE ratio, a low PE ratio. I think the stock is cheap because in the past it has always been trading at a high valuation and now it is dropping. Yeah, maybe it's because the things have changed. The thesis has changed. The business has changed. And now it's a lower quality business. And this lower PE ratio is warranted. Only looking at the numbers will not help you here. You need to look at the quality of earnings. And when you are having this situation and the PE ratio is dropping for some reason, ask yourself, is the thesis impacted? Has the thesis changed? Has the business changed? If the business has changed and it has deteriorated, yes, having a lower PE ratio is warranted. But if the business has not changed at all, then you have a discount. And then this is when you can buy heavily, I would say. I had this kind of analysis with FICO. I was a shareholder of FICO in the past. I know the company quite well. And this is a company that does the FICO scores in the US, the credit mortgage scores. And if you look at the PE ratio or even price to free cash flow, anything could do the work. PE ratio and price to free cash flow. This is roughly the same. This is roughly the same. Anyway, price to free cash flow. This is the price to free cash flow for FICO, Fair Isaac. And I was buying heavily in 2022. In 2022, the business was still fine. They had immense pricing power, but you had more competitive pressures. You you can look at Upstart at the time. They said that the management team was old school, that the business model was not that great. And at the time, in late 2021 or 2022, we entered a small recession and nobody would care about the consumer anymore. So nobody would care about the mortgage market. And FICO was hated. It was an obscure market at the time. And I was buying FICO heavily at a price to free cash flow of 2025. Guess what? The stock went up massively and it reached a price to free cash flow of 90. So you can guess exactly where I sold the company. But I can tell you that I made a lot of profits. I made a lot of gains on this stock, especially on this trade. What I want to say is when the stock is dropping compared to the multiple of the past, look at this. The price to free cash flow was 50 and it has dropped from 50 to 25. Valuation was cut in half. Is the business changed? Has the thesis changed? Is the business the same or do we have additional problems? If you have problems, then the valuation is warranted. Then it is deserved. But for FICO, the business did not change at all. The pricing power was the same. The margins were growing. The revenue was growing. They were doing buybacks heavily, I would say. And at the end of the day, valuation came back from a price to free cash flow of 25 up to 50 or even more. And now we reached extreme territory, extreme overvaluation. And now the stock is dropping to a price to free cash flow of 40. Much more reasonable. So it will go back to average. What's the average or the median? Yeah, we are almost there. The average is at 40. For the past 10 years, average price to free cash flow of 40, so we are there. And the median at 35, almost there. Okay, so fair enough. You get this. Understand the quality of the earnings and the cash flow. This is really, really important. If you understand all these points, the differentiation of the P/E ratio between industries, quality of the business, quality of the industry, cyclicality, and you know how to spot potential traps, potential red flags, you increase your chances of getting a better performance than the market.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.